Welcome back to Reimagine 2020. I'm Yonah Hochhauser, and this is the Word on the Block powered by Multi.io. Today's Word on the Block is BarnBridge. We're going to discuss what the hell it is, how it works, and why it might just be the next killer big thing in DeFi. BarnBridge is the latest Ethereum project that's making its rounds on crypto Twitter as the new innovative DeFi project. BarnBridge is a derivatives protocol that combines existing lending rates and yield products into bond-like products that divide risk into different levels, or tranches, allowing investors to choose how risky a bet they want to make. A real-world example is how mortgage-backed bonds function, where the safest AAA bonds can be combined with less safe BBB bonds to increase the yield. The new combined bond is then hedged between the two different classes of investors that choose their possible returns according to their risk appetite. There are some big names that are interested in the project. BarnBridge seed investors include Ethereum DeFi heavyweights like Kane Warwick, who's the founder and CEO of Synthetics, the leading synthetic asset protocol, and Stani Kulichev, founder and CEO of Aave, one of the largest lending money markets on the ecosystem. Currently, there are two product offerings that BarnBridge is set to launch in the coming months that will introduce traditional investors to the DeFi world by giving them a safer alternative to what is currently available. Not such a tough task. The first is Smart Yield Bonds. Smart Yield Bonds will aggregate stablecoin deposits from three classes of investors with different risk levels to deposit the funds into Compound and Aave stablecoin interest accounts. The estimated returns are then fixed by splitting the risk profiles between the investors. For example, the safe investor is guaranteed a 3% return, and the more risky investor is guaranteed any additional return above that. In the event of a catastrophic bug were to happen on the smart contract, the safe investor is over-collateralized by the risky investor's funds. Alternatively, any additional interest generated from the safe investor's funds are diverted to the risky investor's yield. Pretty smart. The second product is called Smart Alpha Bonds. Smart Alpha Bonds will create index-like products that are protected with decentralized options to dampen the volatility of the underlying asset. An example strategy is by offering a derivative of the Ethereum token ETH that is divided into risk profiles where the high-risk investor's returns can be subsidized by the safe investor's deposits. Alternatively, if the asset returns a negative return, the safe investor's funds are covered by the high-risk investor's funds. And just like any new exciting project, they got a token, Bond. Bond is an ERC20 token that will function as the protocol's governance coin. The token will be used to stake in the DAO system to propose and vote on changes to the protocol. In BarnBridge Medium post titled DAO First, a new governance model, the team has expressed their interest in a token model similar to that of the Synthetic and Aave, where the stake tokens provide an insurance-like backstop for any protocol failures and then should be rewarded with protocol fees. Let's talk tokenomics. According to the project, BarnBridge was launched with a clear token distribution that aims to be transparent and gradually put the control of the protocol in the community's hands. Well, how does that distribution look? 10 million bond tokens total. 60% will go to the community, 8% will go to yield farming, 10% will go to the DAO treasury, and 22% will go to the founders, seed investors, and advisors. Total amount of bond tokens vested will be 2.2 million. As you can see, it's pretty similar to Curve's distribution. So how is BarnBridge doing so far? Well, yield farming is launched, and it's set to reward 8% of the token supply to participants over the course of 25 weeks. That's 32,000 bond tokens a week for those of you who are too lazy to do the math. The bond yield farming program has already attracted $194 million in deposits to the protocol's USDC, DAO, and SUSD pools, which are probably higher now by the time you watch this video. In about a week, liquidity pools for bonds should start popping up on Uniswap due to the circulating supply of bond from the yield farming rewards. At that point, a liquidity pool incentivization program will reward 20% of the total token supply to Uniswap LPs over the period of 100 weeks. That's 20,000 bonds per week. So, in summation, BarnBridge is an interesting project that follows the ethos of the money Lego narrative by combining the most popular money protocols into new products that can attract traditional investors to the world of DeFi. The project's yield farming and liquidity mining programs have attracted a large audience, but time will tell if these users are here to stay. What do you think? Is DeFi bonds with different levels of risk something that interests you? Let us know in the comments below. For Reimagine 2020, I'm Yonah Hochhauser. Make sure to check back here for all the latest blockchain news, interviews, and more. That was your Word on the Block.